This is the Nedgroup Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you. I'm chatting with Ian Anderson from Bridge Fund Managers, the portfolio managers of Nedgroup Investments Property Fund. He is the CIO and has been at the firm for a number of years and has been covering the SA real estate investment trust sector for over 25 years now. Thanks for joining us, Ian.
Thanks very much, Rob. Thanks for being here.
So we've been on a roadshow this week talking to a lot of clients, and one of the things that you've been discussing is how actually this current situation in the REIT market, we have been there before. And would you mind telling everybody what we mean by that?
Yeah, no problem. I think for most people, the REIT market in South Africa started in 2003, because if you go back and look at all the data sets from the JSE, they only start in 2003. But I've been looking at the sector since 1996. And in fact, between 96 and 98, we had a very similar situation take place. It started as a result of a number of crises in emerging markets, the Asian flu of 97 and then the Russian financial crisis of 98. And during that period, we saw listed property prices fall by as much as 50 to 60% over a 2-year period, and yields go from about 12 and 13% to as high as 30%. So this is not uncharted territory for us, but I think most investors, or there were very few investors in the listed property sector back in 1998. So very few people actually know that we've had a similar situation before. And the recovery that took place in the 5 years thereafter was very, very significant. And I think that's something that investors can potentially look forward to over the next 5 years from these levels once the market starts to recover.
And that fall in share price you mentioned there, that 50, 60%, that actually didn't happen to the income produced by those businesses.
No, in fact, I mean, the income was still growing, and it grew. And I mean, there was an expectation that it would start to slow. So the growth in that distribution slowed, and it did turn negative, but only a few years later. But it was just about panic in the market. You had people worrying about what was going to happen to those Asian tigers. People were worrying about what was going to happen to economic growth. The Fed was reacting. They were cutting rates aggressively, just like they are doing today. People were worrying about Y2K, and they thought the world was going to come to an end. I think just like people are worrying about the coronavirus today. So the similarities are very uncanny. But importantly, because most of that income is contractual in nature, it's a rental agreement signed between a landlord and a tenant, and pretty much irrespective of market conditions or economic conditions, as long as the tenant remains solvent, they will continue to pay the rent. So the bulk of that income is secure. And so the distributions didn't go backwards. They kept growing, but the share prices were responding to people panicking in the market.
And so if you continue to hold those businesses, you'll continue to earn that distribution yield. And when the market does see the value in that cash flow stream, then those prices rebound?
Absolutely, and that's exactly what happened. It might not happen overnight, and I think that's the difficult part is predicting when it's going to happen and when those prices will recover and what the catalyst will be. But we know that in the long term, prices are a function of income. They follow the income. So at this stage, we have seen income decline moderately in the listed property sector, but not by the 40-50% that we've seen in prices, and we don't anticipate that. I mean, the market is predicting that vacancy rates in South Africa will go to 30 or 40%. And we certainly don't think that's going to happen. Vacancies are probably going to rise by maybe another 2 or 3%. Most of the companies are doing a very good job in controlling vacancies because they're not doing anything else. They're just focusing on their existing portfolios. So it does seem strange that in these difficult conditions, some of the companies are actually able to drop their vacancies as opposed to have them rising.
And so that it's not broad across the REIT universe. There's certain pockets or certain sectors that are actually able to do what you just mentioned.
Absolutely, and it's something that we've focused on in the Nedgroup Investments Property Fund. There are still property sectors where the economics are and fundamentals are sound. So things like the lower LSM mass market retail segment, businesses like Fairvest and Safari and Vukile, and to a lesser degree Dipula, are all still still able to show reasonable distribution growth, reasonable net property income growth, because the tenants in those properties are doing well. They are benefiting because their customers are all benefiting from the social welfare program in South Africa. We also have a focus on the Western Cape as a region, and so the Western Cape continues to do well, particularly Cape Town. A lot of the office space that did become available a few years ago has been taken up or has been converted into residential or hotel property. So there is a shortage of space. Prices are stable in the Cape Town market. Rentals are more stable than they are in the rest of the country. And so those businesses that are focused to those particular segments of the market continue to do well. And in fact, 65% of the Nedgroup Investments Property Fund is invested in businesses where we anticipate distributions to grow between 5 and 8% a year for the next 3 years, which again is not anywhere near what the sector is going to do. The sector will probably only produce distribution growth of between 0 and 2%, might even go negative over the next 3 years because of what's happening in businesses like Hyprop and Redefine, and I think it'll also happen in Growthpoint. Their results are going to be out later today, so I don't have the numbers at hand right now, but I do think, given some of the issues they have with their capital structures, which they've developed over the last 3 or 4 years, unwinding the problems that they have today is going to come at the expense of distributions and distribution growth, and we've by and large avoided those businesses, and we've tended to focus the portfolio on opportunities where we still see good growth.
And so do you spend a lot of time looking at the tenants of the buildings of the companies that you own?
Yes, we do. I mean, the bulk of the tenants today are either listed entities or large multinationals listed on other stock exchanges outside of South Africa. So we actually get a heck of a lot of information on those tenants. You know, the one of the things that obviously the market is concerned about today is tenant failure, and understandably so, because you've had large businesses like Edgar's under tremendous pressure. I mean, they've rationalized their space. They've closed a lot of stores. Recently, Massmart also came out with a statement to say that they were rationalizing some of their businesses, particularly things like Dion Wired. And so that is a concern that this large tenant failures may start to have an impact on the market. In the Nedgroup Fund, we have tried to avoid a lot of these situations, so you won't see any Hyprop in the portfolio either. Obviously, they have quite a lot of exposure to Edgar's. There's no Liberty 2 Degrees in the portfolio. They also have a lot of exposure to Edgar's. So that is a risk. But I think the bulk of the rest of the tenants are all fairly sound, all fairly secure, and will continue to carry on paying their rents.
Okay, so we touched on the impact of online retailing there, but what about the impact of slowing global growth and the fact that there's a lack of growth in SA? Is there any impact on the lower LSM or the mass market retailers?
No, I mean the mass market retailers obviously benefit because their customers have been receiving social welfare grants, and those social welfare grants are not going to stop. In fact, at a conference here in Cape Town 2 weeks ago, Tito Mboweni specifically said that that's one area that government wouldn't look to reduce expenditure. Obviously, they're focusing on reducing the public sector wage bill. Yes, in the longer term, that probably does have a positive impact, but maybe in the short term, because there's going to be less money in the economy, certainly from a public sector perspective, it will have an impact on the consumer. But I think there've been a number of other positives that we can see today that are going to impact on the consumer. And the first is the fact that we've started to cut rates in this country. We've cut by 25 basis points. In all likelihood, we will get further rate cuts. I think the market is now looking for 75 basis points of rate cuts. We had a very good budget. The 2020 budget was way better than I think most people expected. And now you've also seen a substantial reduction in the oil price. And South Africa is a significant net importer of oil. It has a major impact on the average consumer basket. And so I think at the moment the petrol price is due to come down by about R1.20 or R1.30. And that will be very, very positive for consumer spend in South Africa. And that's been the one area that I think has worried a lot of people with regards to the property sector. I mean, the property sector is dominated by shopping centres. More than 55% of the overall exposure in the REIT market is to retail, and it's the consumer that's been under pressure. So there are some green shoots for the consumer, but clearly now we've also got to worry about coronavirus. The retailers are doing incredibly well because everybody's stocking toilet paper right now.
One big tenant you didn't mention or isn't included in that listed cohort is the government. And one of your holdings, Delta, has a big exposure to government tenants. And so how can you be sure that the government will stay in those buildings?
Yeah, that's also a very, very good question. I think, if you look at the overall government tenancy, so not just focusing on the stuff that they occupy that is owned by the listed property sector, government does tend to occupy buildings that are probably substandard, and clearly one of the things that they need to do, and it's something that they've said they're going to do, is to improve the overall quality of the accommodation for their employees, and that does mean that even the listed property players are going to have to spend a bit of money on their properties in order to retain government as a tenant. Most of the listed property exposure is to some of the larger occupiers within government. So they'll have the entire department, for example, of Home Affairs occupy an office, and for that, under those circumstances, it's very difficult to see government able to move. In fact, right now there is a moratorium that government has imposed on those departments to say that they aren't allowed to move simply because the costs of relocating to new accommodation are too high. So what they've got to do is obviously enter into lease agreements with their existing landlords on the proviso that that landlord will actually spend money on the property, and that's one of the things that Delta is currently doing. They have a capex and opex program running into the hundreds of millions of rands in order to ensure that every single one of their buildings complies with the current standards that government is setting. Importantly, if those standards are met, then government will sign a long lease. They'll sign that lease pretty much at the rental that they're currently paying, maybe just a small haircut of around about 5%, and that lease will escalate at 6.5%. So we are seeing 5-year leases. We're even seeing 9-year leases being signed by government, and that significantly improves the profile of these businesses. And over the last year or so, Delta has been able to renegotiate or renew over 40 leases. There are only a couple of leases that they've got left to go. That was after a period of over 3 years where not a single lease was being renewed. That's also, testimony to the changes that have been made within the Department of Public Works. So all of government's leases are signed by the Department of Public Works, and with Patricia de Lille there now as the minister, a lot has changed, and a lot has changed positively. So all of the companies that we're talking to that have government as a tenant are saying that they've got a much better relationship with government. Government is paying their rent on time, and obviously now prepared to commit to longer term leases.
Okay, that's great, thank you. And then last question I'll ask is, you've mentioned recently that there's some big multinationals looking for space here, particularly here in the Western Cape. Surely that's a positive for South Africa in general.
It is. They're not looking to move businesses into South Africa, but they're obviously looking for space. So the two multinationals that you're talking about are Amazon and Microsoft, looking to install their cloud servers in South Africa. It's a tremendous amount of space that they are looking for. It doesn't exist today, so it needs to be built. It clearly means that the Cape Town office market remains in very, very good shape. And it's, again, one of the areas that we've targeted within the Nedgroup Investments Property Fund for an overweight position. So we own Spear and we own Tower, and those portfolios are predominantly invested here in the Western Cape and specifically in Cape Town. So, although overall the property market in South Africa doesn't look particularly healthy at the moment given the economic backdrop, there are definitely pockets of strength, and we try to capitalize on those pockets of strength within the Nedgroup Investments Property Fund.
One of the things people worry about within the sector is the liquidity of some of the shares in the SAPI and beyond. What would your comment be on that?
Yeah, I think if you look at what was happening towards the end of last year, we started to see volumes in the sector decline. And in fact, in January, we had some of the lowest volumes on record. There was only about 8 billion rands worth of listed property shares changed hands within the South African REIT space. That has changed now that the prices are a lot lower. So we almost saw a doubling in volumes during February, and that those sort of high volumes have been maintained in March. Yesterday, yesterday, in fact, one of the stockbrokers came through to us to say that they just received or they'd been notified by a large institutional investor who was prepared to buy pretty much any property stock at these prices. And so we did see significant volume go through the market yesterday. So I think the liquidity situation is resolving itself, and it always will. There's a price where people just can't ignore the entry into the sector, and I think we've got to those prices now. The sector was hit hard in February. It was down over 15%, and you're now starting to see yields that are too difficult to ignore. And so we will start to see large institutional investors enter the sector again.
Okay, well, thanks very much for spending the time with us today. It's been great chatting to you.
Thanks very much, Rob.
Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.